Okay, welcome to the review session for Exam 2. This exam, the course is generally comprehensive in terms of it builds on itself. There will be some questions that may ask you to link to concepts that you learned for Exam 1. However, the vast majority of the questions will be just dealing with what we've learned since the first exam. Chapter 2, if you'll recall, life insurance, disability, and insurance. Annuities will be covered on the final exam. We covered life insurance, at least the term insurance portion of life insurance, on Exam 1. I might want you to understand some very basic concepts for life insurance in general, but I won't delve into term insurance specifically for this exam. I do want you to probably take a look at the principles of insurance that we covered on Exam 1. Because I will link those principles to the concepts that we've covered since the first exam in a couple of questions. So, that having been said, we'll go ahead and get into Chapter 2. Don't ask you any questions about the insured owner or beneficiary. That will be fair game for the final exam, but I'm not going to cover it on it. This exam. Let's see. I do want you to basically understand the motives for purchasing life insurance, and typically there's a temporary need, and potentially there's a permanent need. I want you to understand in general, insurance is to cover income or assets. So think of those in terms of motivations. Life insurance can be purchased for either one of those. Temporary insurance, also known as term insurance, is covered to replace income. If I'm buying it for estate planning reasons, to preserve the value of my estate for future generations, that is to cover assets. I want a permanent type of life insurance policy, typically a second to die policy. This is the estate preservation piece. Do want you to remember the human life value, the needs approach, and the capitalized earnings approach. So the human life value, that's what an economist would typically use, and this is this is basically how much I make minus how much I spend, or at least the marginal amount that I spend. For example, even though I spend a fair amount of money, my wife would continue to spend most of the money that I spend. If I wasn't there, we'd buy a little bit less in terms of groceries. We'd have probably one car instead of two. But in terms of going on vacation, we still probably have the same house, probably still have more or less the same vacation costs, things like that, if I weren't around. So that's how the human life value approach works. The needs approach is similar to the financial planning method in terms of, hey, we figure out how much you need. It's a time value of money approach, and then we subtract off what we would spend if I wasn't there, like in the human life value approach, and we also subtract off how much I have saved. So the amount I have saved as I get closer to retirement should increase, therefore my life insurance need should decrease under the needs approach. The capitalized earnings approach is similar to the needs approach, but it assumes, unlike time value of money, where by the time my wife were to die, let's say, based upon her life expectancy, you'd figure that the the amount of money that she would need left would be about zero. As is in the needs approach and the capitalized earnings approach, it assumes that maybe she might never die, just to be conservative, so that you retain the value you retain the amount, you retain the original principal the entire time. The capitalized earnings approach is typically going to then require the most life insurance in that case. So I'll ask you some questions about that. I'm not going to ask you specific calculations. So you can look at those if you want to make sure that you understand each method and how it's done, but I'm not going to ask you to do a specific calculation on that. One thing in general that I want you to think about in terms of life insurance is what is most important. Generally, obviously, term insurance is less expensive than permanent insurance. Whole life is generally the most expensive type of insurance, and because it's fixed. And it offers the most guarantees. What is if I have a client and I consider all types of insurance? What's the most important thing to consider? I would argue that the most important thing to consider would be the type of coverage, and then followed by the type of insurance. So if somebody ideally should have $1 million permanent insurance policy, but can only afford the premiums on a $1 million term policy or a $200,000 permanent policy, you should choose the $1 million term policy, and then maybe consider getting a convertibility option so that the clients can convert the term to permanent insurance at some point in the future, hopefully when they have improved cash flows. But the most important thing is to have the right amount of coverage. Just flipping through this fairly quickly. Okay, as we got into permanent insurance, and this is for all types of permanent insurance, but easiest to diagram for whole life insurance. If you'll recall, the way that permanent insurance works is, as the cash, let's say I have $1 million whole life policy, and I'll go ahead and get to the whole life policy. Let's say I have $1 million whole life policy. As my cash, the longer I have the policy, obviously the older I'm going to get, and the more expensive the 1-year renewable term insurance works. So basically, permanent insurance is a combination of a savings element and an insurance element. The insurance element is going to get more expensive, but the savings element is going to grow as I get older, requiring me to purchase less insurance, so that, let's say, by the time I got to age 100, my cash value would be expected 100 or 110, depending upon the life tables used. My cash value would equal the amount of insurance that I should have. So remember to keep that in mind. Okay. Want you to kind of understand the difference between fair game, universal life A versus universal life B versus variable policies. Want you to understand what is flexible in each of one of those policies, how the death benefit is calculated, whether it's flexible or fixed, whether the premium's flexible or fixed, whether the death benefit, the premium, and the cash value are flexible or fixed, and what the choice is in terms of how the investment portion is invested. who has control over it, and what guarantees are. So if you think about universal A, universal B, variable, universal, and whole life policies in terms of those things, you're going to be able to answer several questions correctly. So I'm going to go through this fairly quickly. First to die and second to die policies. I will have a first to die policy if I want the survivor and me and my spouse to have a certain amount of money. Typically first to die policies are going to cost more than two individual life insurance policies. They're going to cost less than two individual life insurance policies, but more than one life insurance policy on each per spouse. The second to die policies are going to cost actually less than either an individual policy on either spouse, because they're going to pay off definitely the latest. A second to die policy is generally for estate planning purposes. So we want that to be a permanent policy, and it is for the beneficiaries. Dividend options. I want you to know what the dividend options are and what they aren't. So if slide 34, we get to dividend options. People often get these confused with the non-forfeiture options and the settlement options. Make sure that you compare the dividend options, the non-forfeiture options, and the settlement options, and that you memorize those and you eliminate any confusion that you have on those. The questions I ask you will be something like, all of the following are included in dividend options except, and I might give you the answer that has something to do with the non-forfeiture option but doesn't have to do with the dividend option. So that'll be 3 questions on the exam, and there will be other questions which will require you to understand that. I want you to understand how surrender charges work. Again, pay very close attention to these slides, like slides 38 and 39 that are in a table. Understand how the taxation of life insurance works versus how the taxation of a MEC would work. FIFO versus LIFO, and understand what that means. I explained that in class. Make sure that you understand that. Understand how we can take out money out of a life insurance contract. It says there can be 2 ways that are pointed out here. There's also a 1035 exchange potentially. I want you to understand that 1035 exchanges, this is the only thing that we're going to mention in terms of annuities. We can go from life to life, from annuity to annuity in a 1035 exchange, and we can go from life to annuity, but not annuity to life. You have to understand that, and the reasoning behind that is going from life to life means non-taxable to non-taxable because the benefits are not taxable. From annuity to annuity means taxable to taxable. From life to annuity means that we're going from non-taxable to taxable. What the IRS won't allow you to do in the 1035 exchange is go from an annuity to a life insurance contract, which is going from taxable to non-taxable. So understand that. Understand the taxation potentially of premiums. Understand. Well, I'll probably get to a slide here in a minute. Here's the 1035 exchange slide that I was just talking about. Transfer for value. Understand that this is the exception to life insurance proceeds not being taxable. So, and it's also the exchange for if I sell a policy. So if I'm an individual and I sell my own life insurance policy, to a transfer for value, particularly if it's above the value that I paid in. I'm going to, let's say I have $5,000 paid into the policy and I sell it to someone else for $10,000. That is a transfer for value, and I'm going to be taxed on the gain in that policy. And then when I die, the new owner or the new beneficiary, typically it'll be the owner and the beneficiary will be the same person in that case, will be taxed. Let's say they have $10,000 in it, and then they pay, let's say, $1,000 a year premium for 5 years, have $15,000 in it. Let's say it's a $100,000 policy. They'll have $15,000 in it, and they'll pay taxes on the $85,000 that they have in it. So make sure you understand that. Understand viatical settlements. Understand accelerated death benefits. And understand that these three things are fairly related: transfer for value, viatical settlements, and accelerated death benefits. Similarities and differences, particularly in terms of taxation and in terms of how they are used. The viatical settlements and accelerated death benefits require me to be terminally ill. Understand the taxation of group and life insurance premiums. So if my employer pays for my life insurance, understand how that might be taxable to me as the employee. And so here's an example, and make sure you go through that. Understand grace periods. Understand incontestability clauses, which are for 2 years. Understand also for 2 years typically is suicide in terms of an exclusion. Be able to apply those things in a problem. Understand misstatement of gender and age and how that might be handled, and how the benefits may be paid out for a material omission or misstatement in terms of gender and age, or any number of other factors that follow under the incontestability. Understand the exceptions to those, what might be considered fraud if I have, which does not have the 2-year time period in terms of the insurance company finding out. If I have someone take a life insurance exam for me, that would be something different than, let's say, I lied about whether or not I smoked. Understand absolute assignment versus collateral assignment. Collateral assignment generally is with a bank. Understand how those work. Beneficiary designations. Okay, here are the settlement options again. Compare these to the dividend options and the non-forfeiture options. Buy-sell. Understand how buy-sells work, and what there's the cross purchase, and then there's the entity purchase, and understand the difference between those things. So this exam will be about 60 questions. Disability insurance. Understand these are the most important policy considerations. Make sure that you understand that. Make sure that you understand what the limitations are on disability insurance and how each of these things work. Go into detail on each of these policy consideration, taxability of benefits, how that works, stuff like that. Residual benefits, definitely want you to understand, going back to work at reduced pay. Understand the difference between short-term disability and long-term disability. For the most part, we are most concerned with long-term disability. That's what may be most catastrophic. Understand this slide. Let's see. We would prefer, in terms of renewability, we would prefer non-cancelable and guaranteed renewable to just guaranteed renewable. Non-cancelable is going to cost more money. Conditionally renewable sucks. We would never consider that. If non-cancelable is roughly the same cost, we're going to go with that. If it's a lot more, we've got to do some, then guaranteed renewable, we're going to do some cost-benefit analysis, understand how benefits may or may not be integrated with Social Security, things like that. And that's it. I'm not going to have you get into any annuity contracts. We'll cover that on the final exam. Okay. Cruising right along, getting into Chapter 3. Let me go back to the beginning. We went through this chapter fairly quickly. I'm not going to make you memorize any of the acts. I just want you to understand how things work. Understand basic medical and major medical, which one's more like a payment plan and which one is more like insurance. Remember, insurance is normally we buy things for catastrophic expenses. That would be the major medical. Basic medical is just basic expenses, going to see the doctor on a regular basis. One of the reasons that we have basic medical coverage, even though it's more like a payment plan, is because if people had to spend several $100s to go to the doctor, they may not get regular checkups and then may get more more life-threatening and expensive illnesses that go undetected. So that's kind of what HMOs basically brought to the table. So you're responsible for knowing what each of those are. Okay, this major medical insurance example. Understand how group indemnity works differently than a major medical policy. Understand how the math on these things works. Also understand that that health insurance is conducted on a calendar year basis. So everything starts over on January 1st, regardless of when you started coverage in the policy. Understand that. Understand that the difference between stop loss and maximum out of pocket, those equal the same thing in one type of policy, and the max out of pocket the max out of pocket equals the stop loss plus the deductible on the other type of policy. So I want you to be able to understand what happens. We pay the deductible, then we pay the co-insurance, all the way up to until we get to either the stop loss or the max out of pocket, depending upon which type of policy we have. So understand the differences. There will be several questions that will ask you what will be covered on this. So there'll be 4 or 5 different questions on this. Make sure that you understand that. Let's see. Understand that eye and dental exams are typically not covered under medical insurance. They do have different payment plan type policies for those that are typically add-on. Okay, understand that pre-existing conditions, while we might want to have those covered, if in groups pre-existing conditions could be excluded, then what would happen is that people would be stuck with one employee that had, let's say, if you had or a cancer survivor, your employer would would have you on the ropes and could say, okay, we're not going to pay you whatever, because they know you'd have to stay there. So that's the reason why we don't want pre-existing conditions to have to be covered. Again, non-cancelable and guaranteed renewal will mean the same types of things with disability policies. Understand HMO, PPO, and point of service. Which one is likely to be the most expensive and least expensive, and which one is likely to provide the most choice and the least choice. Taxation of health insurance, principal of indemnity. If I have multiple policies, I can be made whole but no more, so that'll be coordination of benefits. Understand COBRA. Employees are basically the employee is covered for 18 months for most things, 29 months for disability. Dependents are covered for 36 months. Understand health savings accounts and flex spending accounts. Flex spending accounts used to be use it or lose it. Now, pretty much going forward, starting in the year 2013, employers are going to have the option to allow people to carry them forward. Most employers will elect that option. So in effect, health flex spending accounts will be a lot like health savings accounts, which makes a lot of sense. So it will flex spending accounts will not be use it or lose it. Study this slide because I want you to understand the similarities and difference between HSAs and FSAs. Understand that health savings accounts can be carried forward to age 65 and then can be used to spend on non-medical expenses. You'll pay ordinary income taxes on the distributions, but not the penalty after age 65. So it'll be like a traditional IRA. Versus if that money had been used to spend on medical expenses, then it would be non-taxable and regardless of age, and no penalty. Long-term care. Understand what long-term care coverage is. Understand, like a disability policy, we have things that are known as elimination periods. Normally, benefits are provided for a fixed period of time, as we said in class. Let's say it'll be 3 years, and it might be, okay, we're going to cover you for $200 a day with a 100-day elimination period. So $200 a day, I can come up with an annual amount, and that will be the amount that gets done. More and more policies are going to a fixed dollar amount that's kind of like a bucket. And that's because people would say, okay, if I've got 3 years that's going to cover me for $200 a day, let's say that's about $72,000 a year for 3 years, that's about $210,000. So people started to say, hey, listen, I might want to use this for 2 years because I have a relatively short life expectancy. I'd like to be able to tap in to some of the other benefits to get a nicer facility. So the insurance companies started saying, okay, we'll allow that. Or conversely, if people have Alzheimer's, they may start off in a relatively nicer facility, but if it's seen that they're going to probably have a long life expectancy, they may go into a more economical facility so that they can stretch that out. A fixed dollar amount makes sense. Understand how long-term care benefits work in terms of calculating the needs, work differently for single people versus married couples. You must memorize the activities of daily living. I normally do bathing, eating, dressing, bed, transferring, toileting, TT, incontinence, poo-poo. Bed, TT, poo-poo. That's how I remember it. You don't have to remember it that way. You just have to remember there are the 6 activities of daily living, and if you are unable to perform 2 of them, you have satisfied the need for long-term care coverage to start paying for you. That's the end of the slideshow on that, and that is the end of the review for this chapter. Best of luck on the exam.